Welcome to day number 3 on the Beginner Bootcamp. Today we are going to be going over understanding liquidity and understanding value. So let's go ahead and get right into that. So what are we going to be covering today? Liquidity pool. That kind of ties into understanding value, understanding where price wants to go, why it's delivering to where it's delivering to, and what the things are that price is delivering to. So, super important stuff we're covering today. We're going to go ahead and jump off starting with liquidity. So, intro to liquidity. Before every major move in the market, liquidity has to be taken. Liquidity is just resting buy stops, sell orders, buy orders, etc., etc. Just like a massive amount of orders in a certain spot that the market needs to draw to in order to continue moving. Understanding where liquidity lies, how it builds, and when it is targeted is one of the most important concepts in trading to understand. So today you're going to learn what liquidity is, where it comes from in bullish and bearish moves, how stop losses become targets, why price sweeps liquidity before making the quote unquote real move. And once you understand this, you'll stop being liquidity and start using it to your advantage. That is the entire purpose. So, liquidity in a bullish trend. In a bullish trend, price generates sell side liquidity at swing lows. We mentioned that in day one. Traders long the market, placing stop losses at each low. That's where the money pulls up at those sell side liquidities. Market makers target those areas before delivering price higher. So, therefore, before you enter a long, expect price to sweep those lows, if not a few of those lows first. So, as you can see on this illustration I made, every time we make a swing low, sell side liquidity is being created. That's because traders who are buying place their stops at those lows. This builds pools of liquidity that price wants to / needs to grab first. The market will usually return to those areas, take the stops, then continue higher. Understanding this will help you avoid being stop hunted before the real moves happen. So you're not longing here, you're not longing here, you're not longing here. Whenever you see something like this, you see it's obviously the same thing on a bearish chart. We create these buy side liquidities, buy side liquidity. We then take this buy side liquidity, which is a fake out move. People are definitely going to be longing this, putting their stop losses here, but we know the market is just trying to grab that liquidity resting at the highs before we then short. So, super simple, sort of. And liquidity in bearish trends. In a bearish condition, it's the same idea, just flipped. Liquidity builds above swing highs. That's where sellers are placing stop losses. This creates buy side liquidity, or BSL, which the market seeks to grab before making its move down. Again, this illustration, perfect. We've got our buy side liquidity, our sell side liquidity. In a bearish trend, every swing high builds buy side liquidity. Sellers shorting the market usually place stops above these highs right here. Price will often run these highs first to hit the stop losses right here before dropping. So don't short early. Wait for the buy side liquidity to be taken first to avoid getting stopped out. It's the same principle in sell side liquidity in bullish trends, just reversed. So don't be liquidity. Do not be liquidity. Most people get stopped out because they enter too early or too late. You don't want to long before sell side liquidity is taken, or obviously buy side liquidity is taken. And you don't want to short before the buy side gets run. Price almost always sweeps liquidity before making its real move. So bullish, as in bullish starting off, in this bearish example, people try long too early. They see a low form, think it's the bottom, and place their stops right under it. But price is just setting up to sweep that liquidity, the $ marked liquidity up here. After that stop hunt, the real bearish move, that's wrong, I'm sorry. The real bearish move begins. So don't be early, wait for the sweep before entering. You see, we sweep here, and then we continue with the real move short. If we entered here, we would have gotten stopped. Price almost always sweeps the liquidity before making its real move. So keep in mind liquidity exists on both sides, buy and sell side liquidity. In a bullish example, price has a high, a low, both areas hold liquidity. In this case, up here, price runs the first sell side liquidity, the white, then it reverses to go after the buy side liquidity in the green above the high. This is a common sequence and should be expected before getting the real delivery. And in a bearish example, price takes the buy side liquidity at the high first. After clearing that, price sharply reverses. It then targets and sweeps sell side liquidity sitting below. The real bearish move begins only after both sides are manipulated, and this is how smart money uses liquidity to trap traders and fill larger orders. Liquidity builds on both sides of the market, highs and lows. Price will often grab liquidity on one end, then reverse and hit the other side. Understanding this pattern will help you make way more money in trading, and I promise you that. So, liquidity recap right here. All right, liquidity recap right here. That wraps up the liquidity section. So here's what you should now fully understand about liquidity before we move on to the next section. Liquidity forms at swing highs, swing lows. In bullish trends, liquidity builds below swing lows. In bearish trends, liquidity builds above the swing highs. Stop losses or liquidity. The market seeks these before making its real move. Your job is to avoid becoming liquidity. Instead, trade after that liquidity sweep. Price will then often fake one side, take liquidity, then reverse to deliver the actual move. This concept is everything. And if you don't understand liquidity, you will always be chasing entries that fail. So from this point forward, ask yourself, where's liquidity sitting and hasn't been taken yet? If you cannot answer that question, you should not be taking the trade because you do not know where the market should be delivering. And let that question guide every single trade you take. So, liquidity pools and types of liquidity. This ties into understanding value. The types of liquidity that you're going to see are types of liquidity. We already covered what liquidity is. Now we're diving into the types of liquidity that you'll actually see on your chart. And there's two categories: session liquidity, which are, like Asia, London highs, London lows, New York sweeps, etc. And internal liquidity, as in inside of the range that you're currently looking at, are things like buy side liquidity, sell side liquidity, equal highs, equal lows, low resistance liquidity, and data highs and data lows. At the end of the day, it is not really that complicated. It's just about identifying where orders are sitting and which highs or lows are worth paying attention to, then identifying when they sweep and knowing what direction that you're going to take your trade in. I'm going to show you how to recognize the right liquidity so you know which levels actually matter. High time frame liquidity or session-based liquidity is understanding the session liquidity is huge. Price reacts to these levels all of the time, and here's how it works. So let's say Asia session creates a high and a low, and then London session opens, does its thing. We then come into New York, open. One of two things will happen. If we sweep London lows, price will likely run back up to London highs or even Asia highs, depending on where they're located. If we sweep Asia highs, expect a reverse and trade down to London lows in this example, obviously. These session levels become key liquidity pools that the market reacts to almost every single day. To mark this out properly, use an indicator like ICT kill zones and pivots. It's ICT kill zones and pivot, TFO, trade for op. I believe we already went over that indicator and I showed y'all how to put it in your trading view. It will help you identify session ranges with absolute precision because it shows you exactly where the highs, the lows, and the entire session is. So Asia session right here is the purple box. We've got London session as the blue and New York session as the gold. You can see in this example, London lows swept, price you can see London lows got swept, price reacts, trades up to London or Asia highs. If Asia highs get swept and no displacement, price will likely trade back to London lows. Price consistently and constantly reacts off of session highs and lows. So you need to study these daily ranges like your life depends on it. Session liquidity is also known as high time frame liquidity. or session-based high time frame liquidity. So now we're going to get into low time frame liquidity, which obviously is self-explanatory. This is liquidity that you're going to be seeing on the lower time frames, not like the 30-minute and above. So we're going to be zooming in onto the lower time frame liquidity. This is where your entries will happen because you're not entering on the 30-minute or the 1 hour, or really you're not entering on anything above the 5-minute, or you shouldn't be. So here's what that includes, right? So you've got buy side liquidity, resting stops above highs, sell side liquidity, resting stops below lows. Equal highs and equal lows are just clear magnet zones where price has just equally reached like a spot on two separate candles, and it's just two perfectly equal highs or perfectly equal lows. Usually the market doesn't like to leave these, so we will go back to retrace to those levels. And then we've got low resistance liquidity, which are just stacked highs and lows that haven't been swept yet. This is exactly the stuff that price grabs before it actually makes a real move, besides obviously the higher time frame liquidity that we talked about. And we use these levels for entries, targets, or to stay out of bad trades. So you can see right here, we got our buy side liquidity resting above the highs, our equal highs right here, our low resistance liquidity, and then price will likely sweep these areas first, then moved in the intended direction. And this is where retail gets trapped. Your edge is knowing where these liquidity zones are. It's not just support and resistance and knowing like, okay, here, and then we're gonna react off this and then the blah blah. Like you just, if you use this correctly, you will know where the market is supposed to be drawing to, and that is the most important part of trading. That and obviously your risk management, psychology, and strategy. So, sell side liquidity, obviously the same sign as buy side liquidity. In bullish price action, swing lows are sell side liquidity. Why? Because that is where buyers are placing their stop losses. If you're in a long and price starts pulling back, where are you going to put your stop? Below that last low. So whenever those lows stack up, it is a pool of resting sell stops, aka liquidity. Before any real move higher, price is going to sweep those lows first, take out that liquidity, and then give you the proper move. This is exactly why we don't long into a range full of unswept lows or unswept liquidity. We wait for the sweep and then we enter the trade. It is as simple as that. You just wait. Trading is a waiting game. Your goal in the market is to preserve your capital to your fullest extent and only take high probability setups. So each swing low is sell side liquidity. That's where retail longs are placing their stop. Price comes back, sweeps sell side, then moves higher. Price sometimes will run all sell side liquidity before reversing. If you want too long after the sweep, not before it. Always after a liquidity sweep. Yeah. So buy side liquidity, same thing as sell side liquidity, but reverse. In a bearish scenario, it is the opposite. Every swing high that hasn't been run is buy side liquidity. That is where stop losses for shorts are sitting, or breakout traders are waiting for that breakout. So therefore, any real drop in price usually trades higher to sweep those highs, trigger stops, then tank. Never ever short into a clean high that hasn't been swept. Wait for the buy side liquidity to get taken first, and that is when you strike and take your trade. Equal highs and equal lows. Pretty self-explanatory. Just 2 points on the market that are equal to or more points on the market that are equal at highs or lows. This is one of the easiest types of liquidities to spot and also one of the most dangerous for traders who don't understand it. Sorry. Equal highs or equal lows are obvious stop placement zones. If two or more candles trade to the same high or low, it's guaranteed liquidity. Everyone sees it. Everyone thinks it's a safe level. It's not. That is where big money targets first. They want to see those equal highs or equal lows get taken before we then continue in the proper direction. Equal highs, equal lows. Pretty self-explanatory. Not going to go too in depth on that. So low resistance liquidity, or LRL, are just stacked highs and lows that are just kind of, it's almost like seek and destroy conditions. Obviously, this is a beginner boot camp, so I'm not expecting you to know what seek and destroy conditions are, but it's basically just choppy price action where we're still continuing in a direction, but we just have stacked highs or stacked lows. that will usually get swept. And basically, low resistance liquidity happens whenever you just get a bunch of clustered highs or lows that haven't been swept yet. This is price just building up liquidity with no reaction, and it's just basically weak price action. When price returns to this area, it's often just going to rip right through it because there's no structural resistance or rejection there. It's just basically a wall of stop orders. So you got to think of this as a stacked shelf of untapped money. Price doesn't hesitate whenever it comes back here at all. And data highs and data lows, we already did go over it, but I'm just going to give you a fresh reminder. News events create instant liquidity pools, especially red folder events like CPI or NFP. At 7:30 a.m. CST, let's see, a single candle will often wick hard in both ways, top and bottom. That wick, data high or data low, or data high and data low, depending on the direction, is where they are. But price is very reactive to these zones, and you can treat them like session liquidity. They act the exact same way as session liquidity. If price sweeps data low, you can expect a reaction to push towards data high, and vice versa. You can see right here we have our news candle, data high, data low. This is a bullish candle. So, types of liquidity recap. So, here's everything we just went over. Learn to recognize these setups, and you will know where price wants to go. High time frame liquidity is session highs, session lows, Asia, London, New York. Sell side liquidity, buy side liquidity, swing highs, swing lows, stop resting zones. Equal highs, equal lows are just equal highs and lows, easy sweep setups. Low resistance liquidity, accumulated highs or lows, just weak zones in price. Data highs or data lows, news candle wicks, just reactive price zones. And an optional add-on is previous day high, previous day low. That is also a liquidity pool. So this is our day 3 wrap up. Now you know what liquidity is, and today you learned what equilibrium, discount, and premium actually mean. I gotta fix it. So, day 3 wrap up. You made it to the end of liquidity, which is honestly, in my opinion, one of the most important parts of trading is obviously knowing where you want price to go. So, today you learned how to use those concepts with confirmation and IFEG entries, how liquidity moves the market, and how to use it to your advantage. The different types of liquidity, session-based, swing highs, lows, equal highs, equal lows, low resistance liquidity, data highs, and data lows. If you understand this, you will start looking at the chart through this lens, and you'll stop being the one getting stopped out and start being the one catching the move and knowing where the market is targeting so you avoid getting stop rated, so because you know where price wants to go or react to and then react off of. So review this section as many times as you want. Watch this video as many times as you need. This is the foundation on how smart money actually moves price. I hope you enjoyed day number 3. Like, subscribe, stick around for day number 4. If you haven't watched day number 1 or 2 yet, I recommend you go back and watch that. Anyways, thank you for showing up and have a great day.